Hello and welcome to our video. This tutorial is a follow-up to the one we presented a week ago on using the worst drawdown metric to help evaluate trading systems. In this tutorial, we will discuss the annual ROI metric with an aim to answer the following questions. How can we use this metric to filter out systems that are not relevant to our financial goals or risk tolerance? How can we use it to critically assess systems that seemingly show promise? And finally, what are the pros and cons of using this metric? In short, what valuable information might it reveal? And if used solely without research or scrutiny, how might it be misleading? Before we get started, please take some time to view our risk disclosure. Remember that past performance does not guarantee future results, and that any presentation of systems in this video is for educational purposes and doesn't constitute any trade recommendations or any investment recommendations as well. Also, hypothetical results have inherent limitations, which you can read by going to our risk disclosure page via this link. ROI stands for return on investment. So annual ROI is a yearly return on investment averaged over the period of years in which a system had been trading. The formula for ROI is net profits divided by the cost of investment, and that figure times 100. Now let's go over a few pros and cons, starting with the pros. The annual ROI metric includes commissions, fees, and cost of average execution slippage. In other words, it takes into account net figures. Historical profits and losses are transparent. This means that you can get details on a per trade basis for each month for each system. Now let's go over a few cons. The main one, really the only one we have listed, is that annual ROI includes both live and hypothetical trades. If you go on our site, you'll notice that the total P&L and total ROI includes results from live trading, back-tested trading, and tracked trading. The pros are fairly easy to understand, so let's focus on the cons. In other words, what it means when both live and hypothetical trades are combined in this metric. We produced a short but detailed video titled Evaluating Algorithmic Strategies, Hypothetical versus Live Results, and I suggest you take some time to view it. Let's go over a few points. Every successful system was at one point a hypothetical system. This means that there are many new systems, some of which may show promise, that just have not had the chance to be traded with real capital. There's also a risk in being one of the early adopters of a new technology, so it's important to view all of the metrics before choosing to engage in a system that hasn't been tested live. Last, there's no guarantee that a profitable live system will continue to be profitable in the future. This is just a basic reality of market speculation. Some systems will continue to trade profitably while others may not. For this very reason, regulators require a clause that most of you have heard repeatedly. Past performance does not necessarily indicate future results. Suppose you want to use annual ROI as a metric for system selection, but perhaps you also feel more comfortable subscribing to a system that has a fair amount of live trading. In this case, you'll want to sort the data by annual ROI and cross-check it against live P&L. Here's how to do it. First, go to our Algo IQ page and click on Annual ROI. This will sort ROI data from highest to lowest. Next, go to the Customize Table menu and select the following: Tracked P&L, Live P&L, Suggested Capital, and Live Since. Scroll down, click OK. Now they all appear on your screen. Okay, check the Live Since date. So you'll get a sense of how long something has been trading live. The start date might have been several years before it started trading live, but you want to be able to distinguish between the two. And also check worst drawdown against required capital. So here's the worst drawdown, here's the suggested capital, required capital, The important thing to note here is if you had started trading the system right at the peak before its worst drawdown, and if you had funded your account with the required capital, you would have sustained quite a significant loss. However, if you had funded your account with the suggested capital of $15,000, you'd have sustained just a little bit over a 2% loss in equity. So let's take a look at this first system. This has the highest annual ROI of 139%. However, it's been trading live for less than 3 months. Let's take a look at it. Click on the row and it'll bring up the details. You can see here, yes, it's been trading live for less than 3 months. Is this a system that you might want to trade, might want to subscribe to, or might it be too risky? That's really up to you. But it's important to look at all the metrics before you make your decision. Let's take a look at the second system on our list. Notice how it says it has an annual ROI of 111%, has a total P&L of $509,920. However, take a look at the tracked P&L. Negative 12,206, and the live P&L, negative 27,961. How is that possible? Well, that just means that during its back testing phase, it showed that it was a potentially profitable system. However, when it started tracking and when it started trading live, it wasn't very profitable. Let's take a look at the fourth system on our list. It states an annual ROI of about 93.2%, where drawdown is negative $8,990. But let's take a look at the live P&L and the tracked P&L. You'll notice that the tracked P&L is positive and the live P&L is also positive. So might this last system be a system that shows some promise? Might it be something that would be worthy of investment? It really depends on the individual investor or trader. The main point here is that annual ROI by itself will not tell you much. You have to check the other metrics, check other data that might be relevant to your analysis. For instance, if a system states a high annual ROI, again, that's combining back-tested, tracked, and live results, then what does it mean if the live results are negative? It also depends on how long a system's been trading. What if it's negative, but it's been trading only for a month, versus a system that has a negative P&L that's been trading for a year? Are there inconsistencies between the tracked P&L and live P&L? And if so, for how long? Check the worst drawdown. Is it greater than the required capital? What does that tell you? You want to take a look at as much relevant data as possible before you make a decision on whether or not to subscribe to a system. You want to get a big picture view of the system, and looking at all the details is really the only way for you to get that perspective. Thanks for watching our video. We hope you were able to learn something from this exercise. If you have any questions or feedback, contact us at team@halifaxamerica.com. In the following weeks, we'll continue producing tutorials to help you better understand and evaluate algorithmic trading systems.